Hello, thank you for joining us today. My name is Chris Rees-Williams and I work in the London Residential Development team at Savills. I'm delighted to welcome you to our property market update in collaboration with St George. I'll shortly be handing over to Katie Warwick. Katie is the head of London Residential Development Research at Savills. And following this, Craig Burrido, who's the head of sales at St George, will be giving overviews of two developments which we hope are of interest to you. Filmworks is located in the heart of Ealing and has homes that are ready for occupation now. And Grand Union in Alperton, where we are located today, is a large regeneration scheme, and Phase 2, Waterview House, recently launched to the market. Whether you are looking to purchase a home now or one that's completing in a few years' time, we do have options for all buyers. Without further ado, may I please hand over to Katie for the research segment of our market update.
Hi there, I'm Katie Warwick and I head up the London Residential Development Research team at Savills, and today I'm going to talk you through a few slides on the London market, a bit about what's going on with house prices, activity in the market, and also some of the changing consumer trends. So I'm just going to talk to you first about why to buy in London, because actually I'm aware that some of you may not already be based in London. And obviously London has seen a lot of uncertainty. It has faced a lot of uncertainty over the last 4 or 5 years since that vote to leave the EU. And that has added uncertainty on the political and economic spectrum. And then, of course, COVID hit. So we've had additional uncertainty in the face of a global pandemic. But I'm just going to touch on how London has fared throughout this period. So since we have left the EU, the UK has now got trade deals agreed with Japan and Australia, and there are more underway. And I think this is a really positive sign for how London and the wider UK markets emerge post-Brexit. And of course, businesses in this context have stood strong, and they're still attracting some of the biggest names. So over the last few years, we have attracted Apple and Google, who have both commissioned for their headquarters to be built in London, so at Battersea Power Station and in King's Cross. And I think that's a really sort of strong message to the market that London is still a really important place to be. And that is for some of the larger tech occupiers as well, including TikTok and Netflix, who have both looked to take new office space over this period. And we think that London is ready-made to adopt to this new normal. And by that we mean that actually this hybrid model of a shift towards more people working from home, we think this is likely to stay to some extent. And I think that London, with what people want from their homes, they want to have all of the amenities very local to them. We know that green space is particularly becoming more important, and we know that London is an exceptionally green city. And I think it's got about 44% of London's area is actually green space, and that compares very favourably compared to New York at around 25% and Paris at around 10%. And then finally, the London fundamentals mean that we do think there's long-term security and stability, and it has seen strong price growth over this period, and we think that actually it is a relatively resilient market, not least because it has the fundamentals of the English language and also being in the correct time zone to operate with all of the other markets across the globe. So just to back that up with some statistics, we think that London is leading in terms of the cross-border investment, way ahead of Paris. I think that's 40% more than Paris, and also Amsterdam, and so comparing really favourably with all of those other global markets in terms of the investment coming to London. At a time when total cross-border investment was down, London still fared really well. And that also is corroborated by the level of investment into tech. And you may not think of London as a tech leader, but the stats certainly suggest that that is true. If we look here at venture capital investment into London, you can see that that has been increasing really rapidly over the last few years. And even last year, where total investment into tech went down globally, London held its position there. It was only 2% lower than 2019. I think that is frankly remarkable. There are also signs that London is taking some market share from Silicon Valley, not least because a significant proportion of the money that is invested into tech in London has originated from North America itself. So to demonstrate to you why we think, London is going to come out of this pandemic and it is really resilient and will be strong in its recovery, is one of the other fundamental features of the London market, why it's so attractive, is its really strong university offering. And this means that it is incredibly attractive to people from the rest of the UK to come to London to study, but also overseas. And what that means is that London retains some of that very talented workforce and offers those business in London to be able to capitalise on a really sort of top class pool of workforce there fresh out of university. And despite Brexit, we can see that actually the level of international applicants for London universities has continued to go up throughout this period. And I think that is, again, it's really remarkable and just proves how resilient this market is and how attractive it will continue to be going forward. So now I'm going to touch on the housing market and talk about the activity in the market. I think it's fair to say that there's been a bit of a frenzy of activity in the market during COVID, and it has surprised us all. I think in April last year, you can see that activity in the market in terms of the sales agreed dropped off quite significantly. This is looking at London, but it's the same picture when we look at across the whole of the UK. And you can see after this point, when the market started to reopen, as we came out of that first lockdown, you can see the activity started increasing to above 200% compared to what we would consider a normal market, the level of activity in the market the previous 2 years prior to COVID. There are a number of different factors happening that are really significant in the market at the moment. This reassessment of housing needs. I've already talked about people working from home more often and wanting green space, and for these reasons alone, people need more space in their homes, and it has made them rethink what they want from their property, and in many cases which location they want to buy next in. There has been relatively low growth in the market in the 2 years preceding the pandemic, and that has meant that the market is less exposed to a significant price fall. We've got low interest rates at the moment, record level low interest rates, and that is likely to stay the case for the next few years. And then we've had significant government support for jobs and for earnings, and as well as that stamp duty incentive, which has really provided that additional impetus for people to buy now. So all of these factors have led to this really strong rebounding in the market in terms of this surge of activity. And during the course of the second half of last year in particular, the headlines across the UK were record levels of mortgage applications, record levels of housing sold, and applicant levels. So, all of these records led to this surge in activity. And that started to drop off slightly as we approach what we've shaded in yellow here, which was the new year. And the significant event that happened then was that the stamp duty holiday got extended until the end of March and is now been extended. It tapered down to the end of September. And we started to see that as well as this sort of maybe the slightly frenzied activity starting to come to a bit of a close, has led to activity coming off slightly. And you can see that while it does look quite a dramatic line, it is still above the level of what the average was 2 years ago. So it's still operating in a more stronger environment than it was 2 years ago. There are some differences by price band, and it has the one key feature of this market is that the higher price bands have outperformed the lower price bands, and this is because it's those people who have been able to move have been slightly higher earners. They potentially, they haven't been subject to furlough. They've got more financial stability, and they have been perhaps looking to upsize their homes. So it's less about the first-time buyers, and actually it's the home movers who have been more active in this market over this time. So I'll talk you through a little bit about where we think this is going next. So in terms of thinking about our forecasts, the furlough scheme and the stamp duty extensions, they will mitigate the short-term risks. We had expected there would be a drop-off in activity, but we think that actually it's likely to be a tapered down, levelling off towards the end of the year. So we've seen record levels of price growth in the first half of this year, and we expect that to taper off slightly towards the end of the year. And throughout this point, we've obviously got the vaccine rollout and the easing of social distances, and then that also has led to the falling unemployment levels in the second half of the year as people are starting to return to a new normal. I will admit that actually, this prolonged period of lockdown, it has embedded some of the perceived need for more space. So, that isn't going to go away. I think people are not going to want to then go back to living in very small homes. They are going to still be thinking about a space to work from home or having an additional sort of spare room, ideally. But we must acknowledge that in London, affordability is really tight. So people are still going to be, buying one-bedroom flats. Not everybody can afford to have that spare room. The expectation is that interest rates will stay lower for longer. I'll show you some figures on that shortly, and that will underpin house price growth. However, in particularly for London does have such an affordability challenge that when those interest rates do start to rise, and however minuscule that rise may seem, London is very exposed to very small rises in interest rates because affordability is just so stretched. It is a unique problem for London compared to the rest of the country. And the government has announced a mortgage guarantee scheme, which for some, may say, that's great. But for London, I think, this isn't going to really affect the market significantly. Firstly, it won't affect new build. It isn't currently eligible for new build properties, but also just because house prices are so high, I think that with the deposit required and the loan to income ratio, that's the key thing here, restricting threshold of who can access that scheme. That's going to be very restrictive. So now that leads us on to our forecasts, and I mentioned earlier that we've revised our forecasts because of the strong growth that we'd seen in the first half of this year. So we were expecting that there would be more of a tail off this year, but we've seen a really strong first half. We think that actually, remember those lines we're pointing down in terms of the activity, that is starting to come off, and it started to come off more significantly in the last couple of months. So we do think that house price growth over the course of 2021, it will still be very strong, relatively speaking, but it is starting to come off towards the back end of that year. GDP growth, of course, will start to pick up, has already started to pick up, and unemployment will peak this year, start to come off thereafter. And thereafter, we will see that actually house prices do come off more significantly because you can't sustain these very high levels of house price growth at a time when incomes are simply not increasing at the same rate. And clearly there is a correlation there between what is happening in the wider economy and what is happening then in house price market. You can see that actually, especially for London, which sees less growth than the wider UK at the back end of this period, it is specifically related to this increase in the bank base rate. So just to start thinking more specifically about these local areas, we've got on a chart here, we've got the average, what the increase has been in prices compared to the average house price in the peak just before the financial crisis, so 2007, 2008. You can see where prices are relative to that point in each of these boroughs. So we take London as a whole and the South East as a whole as the region, and then Ealing and Brent as the London boroughs. And you can see that, interestingly, both boroughs have performed relatively similar to the London average. They have seen significant long-term price growth, and in particular over the 10-year period, you can see how the figures look there. And each of these areas has outperformed the wider South East markets. And if we start to look even closer, even more granular, you can see here what we call a heat map. So the darker red areas show higher average values as at the Land Registry as at February this year, and the lighter sort of yellow and oranges, they're much lower values. And you can see, so first we're going to take this site in Grand Union in Alperton near Wembley, and you can see that the average for this postcode sector is much lower than the wider borough. And especially this site here, it is located in one of those lighter areas, and what that tells us is that actually there's a lot more regeneration and change coming, because we know that Berkeley are investing in this place, in this local community, and there's going to be significant changes happening, and that is likely to close that value gap with some of the surrounding areas. And if we next look at Ealing, so the Filmworks is in Ealing town centre, and this is a slightly different story because Ealing is firstly on Crossrail, and it's also already seen a significant level of investment into place by Berkeley themselves and other developers who have really focused on improving that town centre. And so house prices in this particular area are slightly above that of the wider area, and I think that is to do with the quality of the place and also the connectivity with Crossrail coming soon. Now, I'm sure many of you know that there is a house shortage in London, across London, and we need to be building more homes. And the total figures are that we're currently building around 40,000 homes a year, and we need to be building 52,000 homes according to the Mayor's target. And we see in the local area between these two sites, we see there are a number of clusters of supply that are helping to plug this shortfall of new homes. And there's some interesting things going on. So in White City, there's a number of big sites, but also, there's a lot of change going on. There's Westfield, there's a lot of change in terms of the retail and the food and beverage offering in those areas. In North Acton as well, there's a number of schemes that are in the planning system, fewer that have actually come forward through and under construction yet, but there are grand plans to deliver a lot more homes there. In Ealing, again, I've already talked about the fact that the centre of the town has already benefited from some investment and seen levels of homes increased. And in Wembley, the same. There's been a lot of change. There's been a lot of homes provided for the build-to-rent sector, for the rental market, and there's also been a lot of investment in the wider place, in the community, in the amenities there. So I think there's a lot to benefit from in terms of the immediate wider area, whilst there's relatively little going on in these areas other than these schemes. So I've talked a lot about the sales market, and now it's time to take a turn to the rental market. It has been a very different story. Private renters have been much more exposed to the economy, to those pressures. People who have been previously sharing in London have found throughout this pandemic that they, probably don't, it's not an ideal situation to be sharing in London. They've moved back home with their parents, short term. We have seen less demand from overseas students and also corporate relocations. And as such, we have seen that there has been, with the tourism market sort of not open for business, we have seen that some of the landlords who have had their properties on Airbnb have removed them and moved them onto the rental market, which has added to more stock in the rental market. So a combination of all of these factors, the way that supply and demand has been balancing, has led to some quite significant price falls in rents. And in particular, that has been predominantly in inner London, as you can see, quite different to outer London. And again, if we take a look at this on a more granular level, there have been certain boroughs that have sort of fared better than others. Brent and Ealing, sort of middle of the road there, not too bad in terms of the grand picture, but not as severe price falls, rental falls as in the centre of London. So overall tenant demand has fallen significantly, as you can see here in this period, but more recently, this is really interesting, it started to pick up. So as we've seen the slight return to the office, and certainly as the London sort of regains its buzz and its vibrancy, we have started to see some of those tenants start to move back in particular into the central markets. And what we have seen in terms of the rental growth, and this is using Zoopla data here, we've started to see that annual change for London just start to tick upwards. So we're starting to enter a much more positive rental market. And where does that leave us in terms of our forecasts? Again, we think that 2021 has proved more resilient than we thought. Certainly we've seen some significant price falls, and we think by the end of the year we will be in positive territory, only a small amount, but certainly in positive territory. And thereafter we see that actually the market is going to be much more positive. It's going to pick up in line with the economic growth, in line with income growth, and then we start to see a much more positive recovery thereafter, with London outperforming the wider UK market just because it has fallen just that little bit more, and we see that there's more scope to see a more stronger rebound. And so finally, we know that COVID has affected what buyers are looking for in their property, so I'm going to talk a bit about these shifting trends now. We've done a survey of our Savills applicant, our buyers, and we've compared what their responses were in terms of their priorities for their next property when we asked them now compared to when we asked them before COVID. And I think there's some really interesting changes here. The most significant one, I would say, is around the park and open space. So you can see that that has increased in its importance, whilst being close to a train or a tube station and being close to place of work, those have reduced in their importance. Train and tube station still remains an important factor, but the change compared to last year is quite significant. And I think it's really also quite important to see how shops and local amenities and schools have remained fairly constant. These are the constant things that people rate as really important when they're looking at their next home purchase. And finally, from me, I'm just going to talk about some of the other trends that we're looking at in the development market, in the sale market. When people are looking at a new property, they're thinking about the location and travel. I think some of the changes from COVID, the fact that they are going to be acknowledging that there is going to be continued working from home. People may look at, a slightly longer commute. They might look at moving slightly further away from the station than they had done, say, a year or two ago. I think widely acknowledging that people are going to be working from home, perhaps, they are looking for a bit more space within their property. But as I mentioned earlier, it does still come down to affordability. So whilst everybody would like that lovely new, space to, have a little office or have a spare room, it is going to be constrained by affordability. And I think actually what we are starting to see more of is that some developers like Berkeley are thinking about some of the amenities that are provided in the wider development, so not within your immediate home, but within the wider development. And having some co-working space or business space is proving particularly very important and very popular at the moment, where people can have that sort of slightly separated, work and home place. And certainly thinking also about the priorities within the home. They do want more space, whether they can have some sort of access to open space, whether it's a communal garden. Again, that has been very, very popular. And then finally, sustainability is certainly a strong theme we're seeing across everything we're looking at the moment. We know it's important to buyers and it's also important to developers. And I think there's a number of different ways you can look at this, and quite obviously the new home is going to be a more sustainable product in terms of its energy efficiency compared to a second-hand home. And what essentially that means is that it's cheaper for the buyers, for those residents. And there's another aspect to sustainability, especially when thinking about some of these big schemes that we're looking at today, is that people are thinking more about how they value the amenities around their homes, and the fact that they want to get what is being called in the press at the moment a 15-minute neighbourhood or a 15-minute town. And I think that is exactly what Berkeley are offering here. And they have thought about all of the different aspects of work, life, and connecting with that wider community. And of course, what that means also is that if you're 15 minutes, whether that's walking or cycling, to everything that you need in your day-to-day life, the need to have a car sort of is much reduced, and that again is better for air quality, for the environment, and it also gives more touch points for you to connect with your neighbours and the wider community. So that's all from me. Thank you very much. Bye-bye.
Thank you, Katie. If you have any questions on the research, please do not hesitate to contact us following this market update. I'll now hand over to Craig Burrido to give overviews of Grand Union and Filmworks.
Welcome to Grand Union, one of the most exciting regeneration projects we have within London. The development itself here is going to consist of 3,350 homes set across numerous phases. Next to me here, you can see phase 1 and phase 2. This is made up of Unison House, Affinity House and Tower. Then within phase 2, we have Waterview House and Highbank House. In Unison House, it's going to be home to Twisted Tails Nursery, as well as a 5,000 square foot community centre. Under Affinity House and Affinity Tower is where you're going to find the Co-op supermarket, the residential gym. There's also going to be the residence amenities such as the 2-lane bowling alley and residence lounge. And there'll also be a fantastic bar and restaurant fronting onto Heather Quay, where you see this open piazza area with the fantastic canal boat, which is going to have a pop-up event space. Phases 1 and 2 have 850 metres of canal frontage. Waterview House, which is the first building from within phase 2 of the development, comprises of 155 homes, and residents will also benefit from this fantastic roof terrace on the 13th floor. Here within phase 1 of Grand Union, you can see the amenities that we have. Under Unison House, you're going to have the Twisty Tails nursery, as well as a 5,000 square foot community space that will not only be open to residents of the development, but will also be open to the wider community that already exists within the area. You then have the amphitheatre seating area within the Heather Quay Piazza. It's going to be leading down to this fantastic canal boat pop-up event space that we have. Then we move on to the amenities under Affinity House and Affinity Tower. Within here, we're going to have the gym. We're going to have an on-site letting agent. We're also going to have the co-op supermarket. You'll have the residence lounge, meeting rooms and 2-lane bowling alley. You'll also have the bar and restaurant. Grand Union is also very conveniently located for transport links. You have Stonebridge Station and the Overground and Bakerloo line, which will take you back into Oxford Street in 26 minutes. Alternatively, you have Alperton Station, which will take you to South Kensington in just under half an hour. You can also utilise the Grand Union Canal itself and cycle to the Paddington Basin in circa 30 minutes. So here we are at Filmworks, a development by St George with 209 homes consisting of Manhattans through to 3-bedroom homes. We currently have starting prices from £590,000. As Chris and the team were talking about, the benefit of Filmworks is you have homes that are ready to move into now, or our latest completions will be towards the tail end of 2021. Here we find ourselves on one of the terraces. All of the remaining homes at Filmworks benefit from their own either balcony or terrace space. We're also within 2 minutes walk to Walpole Park with over 28 acres of green space, and also being home to Pitt's Hanger Manor Art Gallery. You can see over my shoulder Dickens Yard, which is home to shops as well as gym box. You're also going to benefit from within Filmworks itself all of the food and beverage operators, as well as the Picture House Cinema that will open towards the end of 2021. Ealing itself is undergoing an injection of regeneration with over £5 billion being spent, attracting operators such as Amazon Fresh, and also the Elizabeth Line Crossrail station at Ealing Broadway, meaning you can be into Bond Street within 13 minutes and through to Canary Wharf in 25 minutes. Thanks very much, and I will hand you back to Chris.
Thank you, Craig. If you have any questions on either of these developments, please do not hesitate to contact a member of the sales team. The marketing suites are open daily, and we will look forward to hearing from you. We really appreciate your time listening today. Thank you so much, and I hope you have a great rest of the day. Goodbye.